Warren Buffett has 7 rules of thumb that he uses to analyze an income statement in just a few seconds. In this video, I'll explain Buffett's 7 rules and show you how his top holding, Apple, stacks up. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. Let's get going. Rule of thumb number 1 relates to a company's gross margin. This is found by taking a company's gross profit and dividing by revenue. Warren Buffett wants this number to consistently be above 40% because it indicates to him that a company has pricing power. Here is a sample income statement, and what we do is we take the company's gross profit of $12,000, we divide it by the company's revenue of $20,000, and this company has a gross margin of 60%, which is well above Warren Buffett's threshold of 40%. Rule of thumb number 2 relates to the company's selling, general, and administrative margin. The formula for this rule of thumb is to take a company's spending on selling, general, and administrative and divide it by the company's gross profit. Warren Buffett wants this number to be under 30%, which indicates to him that the product has established itself as a category leader and likely sells itself. Now, the way that companies lay out their income statement changes from business to business. Some lump them all together under operating expenses, others break them out. In this case, we break out the company's operating expenses. We see that sales and marketing spending is $2,000, general and administrative spending is $3,000. We add those together and we get $5,000 in total spending on selling, general, and administrative. We divide that by the company's gross profit of $12,000, and we get a SG&A margin of 41.6%. Again, Warren Buffett wants this number to be under 30%, so this figure would be slightly over. Warren Buffett's third income statement rules of thumb relates to a company's research and development margin. To find this, we take a company's spending on research and development, and we divide by gross profit. His rule of thumb is that this number is under 30%, which indicates to him that the company is a simple business and does not have to spend big on research and development in order to successfully grow. If a company breaks out its research and development spending, it would be located in the operating expense portion of an income statement. Here, this company spends $1,000 on research and development. We divide that figure by $12,000 in gross profit, and we get a research and development margin of 8.3%, which is well under Warren Buffett's threshold of 30%. Income statement rule of thumb number 4 relates to a company's interest expense margin. To find this number, we take the company's total interest expense and we now divide it by operating income. Buffett likes to see this number be well under 15%, which indicate that the company does not have a lot of debt and is likely to be financed with equity instead of debt. On this income statement, we see that this business spent $1,000 on interest expense. We divide that by the company's operating income of $5,000. That gives us a interest expense margin of 20%, which in this case is slightly above his rule of thumb of 15%. Income statement rule of thumb number 5 relates to a company's income tax margin. To find this, we take the company's total expenses on income taxes and we divide it by the company's pre-tax income. Buffett's rule of thumb here is that figure approximately equals 20%, which is the current tax rate in the United States of America. Why would Warren Buffett want this number to be 20%? Well, that indicates to him that the company is not actively trying to deceive the authorities, and that indicates to him that the management team won't actively try and deceive investors. For this company here, we see that this business spent $1,000 on income taxes. We divide that by the company's pre-tax income of $4,000. That gives us an income tax margin of about 25%, which indicates this business is not trying to deceive authorities. Income statement rule of thumb number 6 relates to a company's profit margin. Now, to calculate this, we take the company's net income and we divide it by revenue. If a company consistently exceeds a 20% profit margin, that indicates that the company likely has a strong competitive advantage, aka a moat, working in its favor. For this business, we take the company's net income of $3,000, we divide it by a revenue of $20,000, and we see the net margin of 15%, which is ever so slightly below Buffett's rule of thumb of 20%. Buffett's final income statement rule of thumb relates to a company's earnings per share. To figure this out, we take a company's net income and we divide it by shares outstanding. Buffett's rule of thumb here is that this number is consistently positive and consistently growing, especially during periods of economic stress, such as 2020, 2008, or 2000. To figure this number out for this business, we take the company's net income of $3,000, we divide it by 10,000 shares outstanding, and that gives us earnings per share of 30 cents. Now, we would want to track this figure over multiple years to ensure that this figure was positive and growing. Now, if you're interested in a simple PDF download that has all of Warren Buffett's financial statement rules of thumb on them, just visit the website longtermmindset.co/Buffett or click the link in the video description and you'll get a free download. Now that we know Buffett's income statement rules of thumb, let's take a look at a real income statement to see these rules of thumb in action. For this, we're going to measure Warren Buffett's top holding as of the time of this recording, which is Apple Corporation. So here are Warren Buffett's rules of thumb. Let's first start by checking out Apple's gross margin. To do so, I'm going to go over to FinChat and load in Apple's ticker symbol, which is AAPL. I'm going to scroll down to the ratios button, and then I'm going to click on margins, and then I'm going to fire up gross profit margin. Now, Warren Buffett's rule of thumb here is that this number consistently exceeds 40%. Now, for many years, Apple was pretty close to this number, but its gross margin was in the high 30s. However, after the year 2021, Apple has consistently gotten this number over 40%, and it's stayed there ever since. So for rule of thumb number 1, Apple gets a passing grade. Moving on to rule of thumb number 2, a company's selling, general, and administrative margin. Remember that Buffett wants to see this number be under 30%. Now, if we head on over to FinChat and we pull up the company's gross profit and the total spending on selling, general, administrative, we can see that over the last 12 months, Apple spent $25 billion on selling, general, administrative, but the company generated $173 billion in total gross profit. If we do that math, we see that this company's SG&A margin is close to about 12% or so. And if we look back historically, we also see that this ratio roughly holds true. So when looking at Apple's SG&A margin, we would also give it a passing grade. Next, we're going to check out the company's research and development margin. We take the company's spending on R&D divided by gross profit, and we want this number to be under 30%. In FinChat, if we scroll down and we pull up the company's R&D expenses, we see that over the trailing 12 months, this company has spent $30 billion on research and development. That is only about 15% or so of the $174 billion in gross profit that the company generated over the same time period. Moreover, if you do that same math looking backwards over time, you see that the company has consistently spent well under 30% of its gross profit on R&D. So yet again, Apple would get a passing grade here. Moving on to income statement rule of thumb number 4, the company's interest expense margin. We want to see that interest expense takes up less than 15% of operating income. Here we are in FinChat. If we scroll down to the company's income statement and we look at the company's operating income, we see that this company generated $118 billion in operating income over the last 12 months. If we take a look at the company's interest expense in total, we see that the company spent about $4 billion on total interest. Moreover, it's generated about $3.8 billion in interest income. So the net amount that Apple has spent on interest over the last 12 months has only about $200 million. That is well below 15% of the company's operating income. So on this rule of thumb, Apple certainly gets a passing grade. Moving on to the company's income tax margin. Remember, we want to see this figure around 20% or whatever the current tax rate is in the United States of America. On FinChat, if we scroll down and we're looking at the company's earnings before taxes, we see that Apple generated about $118 billion in earnings before taxes. And over the last 12 months, it spent about $18 billion on interest income. If you do that math, that gives Apple an effective tax rate of about 15%. Now, while that's below Warren Buffett's general rule of thumb, it's important to remember that Apple generates profits in many different countries, most of which have a lower tax rate than the United States of America. For that reason, I think it's fair that Apple should get a passing grade on this metric. Next, we're going to take a look at the company's profit margin. We take company's net income and we divide it by revenue. Now, thankfully, this is math that FinChat will actually do for us. If we scroll down to the ratios, click on margins, and we call up the company's net profit margin, we can see that Apple over the last 10 years has generated a net profit margin that is well over 20%. In fact, over the last 12 months, the company has generated a profit margin of more than 26%. That indicates that Apple is doing something that gives it a competitive advantage, which would give us a green check mark on this rule of thumb as well. Final number you look at here is the company's earnings per share. We want to see that the company's net income divided by shares outstanding is a positive number that consistently grows. Heading on over to FinChat and scrolling down, we get the company's earnings per share, or EPS. And if we map this number, we'll note that it consistently moves up and to the right, even during periods of economic stress, such as 2020. For that reason, I think we should give Apple a passing grade on this metric too. So given that Apple essentially aced Warren Buffett's income statement rules of thumb, it's no surprise that not only is he a shareholder, but he is taking a massive position in Apple through Berkshire Hathaway. Well, I hope this video was useful. If so, give it the thumbs up and let me know in the comment section below what other financial videos you'd like me to make. Now, if you like this video, there's a really good chance you're going to like this other video I made, so you should watch it next.